Hey, welcome everybody. It's John at Rain King Insights. This is the general market update for August 1st, 2024. It's a Thursday. I'm putting out this update tonight because I'll be traveling and driving my son to North Carolina State for grad school tomorrow. And I wanted to get an update because tomorrow is going to be pretty busy. So this is actually the last free public general market update to start the beginning of a month. At the beginning of the month, there'll be a free one. If you're really interested in getting the weekly updates, just join Rain King Insights, grab a basic membership. It's very affordable, probably the cost of a cup of coffee. You'll get all the information you need to stay on the right side of the markets. Indexes, breadth, sentiment, educational content that I incorporate, as well as some watch list ideas. And I try to keep these really, really religiously short, and I target 20 minutes each time. I know everybody's really, really busy. So hopefully maybe you want me to continue to be a part of your market routine. We'd love to have you continue. Okay, so this update is for educational purposes. We're going to go over the indices. It was a kind of a wild week that we've had and some violent rotations. So we're going to look at the sector rotations. There was talk yesterday. Was it a follow-through day on the S&P? Has the Fed fumbled the ball? You know, Powell spoke yesterday. We got some very weak reports this morning. Sentiment we'll take a look at, and then we'll look at what groups are actually working and some possible names and wrap up. So let's get into the indices and sector rotations. Before I launch in, I want to address how I view the market relative to follow-through days. I just pulled up this old chart, but what's important about it is I look at the indices. When we have pullbacks 3 to 5%, that is considered really normal action. They're just brief pullbacks during a bullish uptrend. And then to me, there's no need for a follow-through day to actually resume the trend when we're in that range. Now, when we get into what I call an intermediate correction, we get to 8 to 12% off the highs, but we haven't broken the 200-day. That would require a follow-through day to kind of reset the uptrend. So I look for follow-through days when we've had these intermediate corrections. And then you can see a bull market correction is 10% plus, and we also break the 200-day moving average, more serious. And then you can see 20% is a bear market, and major bear markets are 25% off their highs. We're closing below the 200-day, and we typically will have at least two failed follow-through days within a 3-month period. So this is going to be relating to this whole idea of the S&P yesterday. So let's look at the S&P. Again, this was some good action on the S&P yesterday. The volume picked up. Technically, some people consider this a follow-through day. I guess it was. I don't look for it because we haven't corrected that much in the S&P. Now, I think what's more important is, you know, Powell spoke yesterday. He was dovish, kind of leading us to believe that rate cuts were coming. But the really surprising thing was the market's reaction. The market stalled out late in the day, and today we got some very weak manufacturing news, and the market really busted to the downside. And it really makes it seem like maybe the Fed has fumbled the ball here. You know, they might have missed an opportunity to start making cuts. So the market didn't like that, and we got some heavy selling going on in the market in various things, particularly in technology. Now we're back below the 200-day moving average after a very kind of weak rally. So, you know, the S&P has been holding up the strongest. It's only come down, I don't know, roughly about 5%. 6% would be down in this level, the top of this yellow box. Could get further down, maybe 10%. So we'll have to see how it plays out. The net highs, new lows is actually healthier on the S&P, and you'll see this comparison when we look at the NASDAQ. So let's look at the NASDAQ. Here we are. We've got much more heavy distribution going on in the NASDAQ, really led by the tech stocks. So you can see we are getting clusters of distribution happening right off the top. You know, we had these major downside reversal days. We've talked about it last week. Now today we had, you know, a one-day rally yesterday, which stalled out at the 58-day, and the 200-day clearly been rejected. Not good action at all. The volumes picked up. And you can also see under the surface on the NASDAQ, new lows are starting to increase. So the market is certainly breaking down within the NASDAQ. Now, an intermediate correction would 15% would actually bring us down to the 200-day moving average. So a 15% correction. If this were to continue to make another leg down, then we'd probably be in the territory of looking that we would need and look for a follow-through day. So at one point, we thought the equal weights were doing better. The S&P equal weight, which is RSP, I've divided that by the QQQ equal weight. What's really interesting is when you do that, you can see since July 1st, the S&P equal weight has extremely outperformed the QQQ equal weight, just really showing us that technology is not in favor. It's not the leading index and the components of it. But the RSP, which is a little bit broader, has shown some real strength, breaking out above this little trend line, and it's starting to try and challenge another one. So it's interesting action. Now, if we dive a little bit deeper into the S&P sectors to say, where is this outperformance if we're trying to find relative strength? You can see I've divided XLI, which is the industrials, by XLK. So when the line's heading up like it is here, this is showing you that the industrials are outperforming technology. Very steep incline here. Over here, we see the home building sector, definitely outperforming technology since early July. Here's the XME, the metals. The metals have been also outperforming the technology stocks, not as swift an ascent as the other two sectors, but it's telling us that the strength is not in technology. Semiconductors, which were all the raise in this last push higher, we've definitely seen that a double top's been put in place. The sector has been in heavy distribution. You can see here, these are some of the heaviest volumes we've seen in a long time, though the astute investor was looking at this entire rally, was seeing a lot of distribution spikes on the way up. Smart money was getting out of the semiconductor trade. So heavy selling now on the way down, and the SMH has not been able to really muster more than 1 day of rally. We had a 1-day rally here and a 1-day rally here, and then it's just met with these wide range bars flushing down. So many people are rushing to take their profits they had while they're heading for the exits. So sentiment. This is the equity put call ratio, and I put the NASDAQ composite in the upper pane in the orangish color. So we've talked about this the last couple of weeks and how we're looking for readings over 1, the green line. That usually means there's heavy put buying, which is bullish, as opposed to when the line gets below this red, that really means there's nobody buying. It's low readings of put buying, and it means everybody probably is bullish, which is a bearish sign. So what I've been showing the last couple of weeks is, amidst all of this selling and the market really correcting, we haven't even gotten up into this area over this heavy put buying. It seems to me that there's just not enough fear in the market with this correction. People are still too bullish, and probably means that the correction or the pullback and correction has further to go to really scare people. That's why I don't think it's unrealistic to have the NASDAQ maybe put in a 12 to 15% correction here over the next couple of months. This is the National Association of Active Investment Managers. This tracks their portfolio exposure levels. And what's interesting is when we see this number get above 85, which is kind of in the green, when everybody's really bullish as an investment manager, it typically marks market tops. We had the January sell-off in early 2024. Then we had this period here in March and April when there was a lot of exposure. People were actually getting on margin, and we had very mixed breadth. So July 1st, we had another spike, over 100% exposure for a lot of active managers, and it's been starting to come down as the market is starting to unravel. Typically at bottoms, we only see their exposure levels at 10 to 20%. You can see we almost got there when we had the big rally start back in November when we got the follow-through day. So it's just another look that's saying people have been very heavily positioned in the large mega cap tech names, and money is exiting right now. So let's look at some groups. and some names. Amidst all of this technology sell-off, we still want to stay engaged with the market and say, well, where is the relative strength? And we should pay attention. So before we do that, let's get to the small caps. Now, the small caps, they had this really push higher. Then they kind of digested, looked pretty good. All of a sudden, though, yesterday, with Powell's speaking, and he actually did not give us a rate cut, we stalled out late in the day. We really had a false breakout in the IWM. And then today, with the weak economic data, people are talking more about recession, and maybe the Fed is going to be late with their actions. So this was a really violent day for the IWM. Now, this is an old chart. This is from April of 2024, when I was saying we really want to look at some of the IPOs that are out there and what new merchandise was forming constructive action to help us with finding stocks. And at the time, you saw a lot of stocks in bases, and you saw many in uptrends, and there weren't that many breakdowns, but they're color-coded. So I've taken the time to update this diagram. So here we are, July 31st. Here's all these different IPOs, and it's not every single one, but it's a good representative batch. So I've color-coded it. Now, it's really obvious when you look at how many are red. And the red means these stocks are very beaten down. They're very much off their highs in wide and loose bases, and they've broken down. Look at the list of stocks that has really been hammered. We also have very few that are stocks, IPOs that are actually in uptrends. There's only a few of them that are really in good uptrends. The market is just really weak, dragging things down. Now, there are a number of bases. The weaker bases, from my opinion, are in black. And the ones that are a little bit more constructive bases, not so deep, and look a little more interesting to me, are the ones in this light blue color. So you might want to check out this for potential names and watch them on this correction, because if they start to show relative strength as we go through a correction, they may be some of the next young leaders. So I pulled this from MarketSmith, just looking at group action to find where the strength was. Here's the top 20 groups as of yesterday. Now, it's a very odd mix of groups. There are still 4 technology groups, biotech groups that are in here, but they're actually sliding in the rankings. There's 5 or 6 defensive groups in the groups. And also there are 3 to 4 cyclical groups. We got some oil, steel, shipping, and construction. There's also gold and silver, and some banking and financials. A very odd mix of defensive groups, cyclical groups, and very few technology groups, telling us again that technology is not the leading space right now. So what do we make of this? And what stocks are doing well? Well, we mentioned the steel stocks. The specialty metals and alloys are doing well. Notice that there's 3 here: Carpenter Technology, ATI, and Universal Stainless. They've all broken out, and they're all in uptrends now. This is just breaking out here. They all have very strong relative strength lines, and they're extended now, so you can't really chase these stocks. Don't do that. We don't want to chase extended stocks. But if we correct a little bit, get a pullback, this is a strong group in the market right now. Now, even the precious metals, if interest rates do come down and we start to get some cuts, precious metals tend to rally in that environment. And you can see here that I've put the US 10-year yield in the upper pane, and this is actually GLD in the lower pane. And you can see typically when rates are coming down, you can see gold tends to have some rallies. Rallied here, but then it's kind of gone sideways as rates went sideways. Now that yields are coming down, you can see that the metals look like they might want to break out and rally. Now, it's all subject to the markets, but what stocks in the groups that might be interesting to keep on your watch list. So here's Wheaton Precious Metals. It broke out of a base very strong, came back down, tested the pivot, and was trying to turn back up. Here's Newmont Mining, one of the biggest miners out there for gold and precious metals. Also, base breakout, pull back to the pivot, and it was trying to make new highs. And Nugget, which actually was one of Rain King's picks that I made in December for my yearly picks. This is a 2X ETF. Got off to an absolute horrible start this year for the first 2 or 3 months of the year, but it's kind of regathered itself as the gold miners might be turning into an uptrend. So these are just some ideas in the metal space to look at. Home builders, I mentioned these last week. They're still, I think, some of the biggest beneficiaries of rates coming down and opening up the housing market. Mortgages rates will come down. The millennials have been locked out of getting affordable housing. So I think there's the different ways to play the housing market. Toll Brothers caters to the very high end custom builds. KB Homes is also focused more on first-time home buyers, and that would maybe be more suited to some of the millennial buyers. Both of them, all these got hit hard today with some of the weak news about potentially a recession, but they haven't broken their trends yet. I still hold a position in KB Homes. So here's the summary. So any rally that we've seen so far, they're dead. Nothing's been really getting any traction for other than a day or two. It certainly looks like we're headed to another leg lower in this correction. We're going to go deeper, which means we need to be even more defensive and cautious in the markets. You know, both the S&P and the NASDAQ have been rejected at the 20-day, and the NASDAQ has closed below the 50-day. Again, just signs that we're in a short-term downtrend at the moment. New highs and new lows. We said the New York Stock Exchange was better and much stronger than the NASDAQ. The NASDAQ has started to see expansion of new lows, which is more deterioration in the NASDAQ. Another couple of things that were really bad signs today is Meta had a very good earnings report yesterday. It was really up after hours, a lot of excitement, but when the market opened, it actually got sold into and finished near its lows of the day. I think that's just representative that people are pulling money out of tech, they're taking their profits, and the whole AI theme, which is going to continue, it's just cooling off for a while. So we're still in a bullish uptrend, so there's no reason to see signs yet that the bull market is over, but we're definitely looks like we're going to correct. Been talking about this, that I've been saying that we might correct and go sideways for August, September. They're really not good months in the market. So, if you're going to play the market right now, I think you've got to really pay attention to what groups are showing relative strength. We showed the home builders, the steel alloys, maybe the precious metals, but stay away from technology right now. I've lowered the exposures a little bit. I don't think you want to have much more than 15-20% in the market. The technology group is very damaged. It's going to take months to rebuild this damage. There's been some serious breakdowns in a number of areas of the technology stocks. So this takes a lot of time. Been a very news-driven week. The Fed basically said yesterday, we're still on pause, but we're open to cuts. I think with the weak data today, if this weak data was given to the Fed 2 days ago, they may have been cutting rates yesterday, but they didn't. So we'll have to see how it plays out, but maybe the Fed has fumbled the ball. As I mentioned, August and September are very weak seasonal months for the market. August tends to be light trade. A lot of traders are away. So this is not a good forecast. So these are not seasonally the good time to be trading too often. So as I mentioned, a corrective period could continue into September. So it's definitely defense, and be cautious here. And there's nothing wrong with staying on the sidelines. If you're in cash, just be patient. There's no real reason to jump back into the market. Take your time, look for the stocks that meet your methodology. So the quote of the week is from J. Wells Wilder. He created the RSI index, which many of us use as traders. He said, letting your emotions override your plan or system is the biggest cause of failure. I think it's really important. Emotions get in the way. We can be too overexcited when we're making lots of money and we refuse to sell. And we can get much too bearish when we're in a bear market or a correction and we stop following the markets. So don't let your emotions override your plan, follow your methodology, and always keep building a watch list of the strongest stocks in the market. As a reminder, we'd love to see you come over to Rain King Insights, check out the site, become a free member if you want to get some of the free membership stuff. And I also encourage you, I hope people want to continue to get these general market updates. I like doing them, and I think people get a lot out of them. So I've heard that. So hopefully you'll get a basic membership so you can get all the market updates every single week to stay on the right side. That's a special general market update for Thursday, August 1st. I'll be traveling tomorrow. It'll be interesting to see what the markets do tomorrow. I hope everybody has a really great weekend. I know in the Northeast, and I'll be going down to North Carolina. It's going to be hot and humid. So try to stay cool this weekend. We'll see everybody very soon. Thanks, care.